Hi, and welcome to my YouTube channel. Today we are here to discuss about the computation of drawing power and cash credit accounts. Before I start with this topic, I would like to give you a brief outline of what would this be covered and how the journey would be. First of all, I'll teach you what is drawing power, what are the characteristics of a cash credit account, how is the drawing power computed, the steps of computing drawing power along with an example, and then we go to the of compliance aspect and the importance of drawing power and monitoring of drawing power in CC accounts. Before we go ahead, just let me give you a brief about myself. Hi, I am a chartered accountant with 17 years of experience working, and I have worked in various banks, finance companies, audit offices, and private companies. I have authored a book from mud to amber, which talks about the journey of a chartered accountant who sought motivation and reached new heights in her career. She built her brand by leveraging social media and started her own practice without spending a single penny. This book is available on Amazon. Kindly grab the book if you are interested in knowing how these things are done. I am passionate about teaching professionals and have helped various finance professionals and bankers in understanding the various concepts in banking and finance domain. Hope this video clarifies the concept of drawing power. Now, moving ahead with the topic. First, we need to understand what is drawing power. Drawing power, it refers to the maximum amount of funds a borrower can withdraw from their cash credit account at any time. Accurately, drawing power is essential for credit monitoring and it ensures the efficient use of available credit facilities. This means, suppose an account has a cash credit limit of 2 crores. Whether the bank will allow the customer to draw the entire 2 crores? No. That particular account, the limit, how much the customer has to draw from his cash credit account would be computed or would be computed based on drawing power. So drawing power will determine what is the maximum limit the customer can draw from his CC account in a given month. So hence computation of drawing power is very important in case of cash credit accounts. Now let's understand a cash credit account. A cash credit account is a type of a revolving credit facility when the borrower can withdraw and repay funds as needed up to a pre-approved limit. So basically a cash credit account is an account that is, suppose you have a 2 crores of a cash CC limit, then you can, and assuming the drawing cost is also 2 crores, then you can use the account up to 2 crores. You can either use entire 2 crores or you can use 1 crore, you can use 1.5 crores. How much ever you are using, interest will be charged only on the limit up to which you have used. So you can withdraw the funds, you can withdraw the entire 2 crores and repay the funds. You can deposit 50 lakhs and you can bring back bring the limit down to 1.5 crores. So it is an account which is revolving. Okay, you can use the limit, you can reduce the limit, you can again use the limit, you can reduce the limit. However, interest would be charged only on the limit which is utilized and not on the entire sanction limit. So flexible access to funds, interest charge only on the utilized amount and the ability to repay and reborrow as required. Now we go to the usage. CC or cash credit accounts are commonly used by business to manage their working capital to meet the short-term financing needs. What are the factors affecting the drawing power? Now, drawing power is computed based on 3 factors. One is an inventory, second is receivables, and third are your outstanding liabilities, which are nothing but your creditors. Now, value and composition of borrower's inventory directly impacts the drawing power. Higher quality, easily marketable inventory increases the drawing power. Now, what does that mean? See, any business will have inventories. Inventories can be in form of opening, it can be in form of finished goods, or it can be in form of WIP, or it can be in any form. So The entire inventory, whether it is a finished goods or whether it is a WIP or whether it is a stock in transit, all the inventories can be taken for the purpose of computing drawing cost. However, slow-moving goods, slow-moving inventories or inventories which are not saleable, those inventories cannot be considered while computing drawing cost. Hence, higher quality, easily marketable inventories will increase the drawing cost, whereas low quality and very slow moving inventories cannot be considered for the purpose of computing drawing cost, and hence we have to reduce those that inventory while computing the amount of inventories which are required to be taken for the purpose of computing drawing. Second is your receivables. As far as receivables are concerned, the age, quality, and collectability of a borrower's account receivables are crucial factors in determining drawing cost. This means that bank will not fund all the receivables in the business. And if you go through the sanction terms of any CC limit, it will be clearly mentioned the number of days up to which the receivables can be funded by the bank. For example, for the purpose of computing drawing cost, receivable up to a period of 90 days will be considered, or receivable up to a period of 120 days will be considered. That line would be very clearly specified in your sanction letter. When they say receivables up to 90 days would be considered, that means that those receivables which can be collected by the customer within 90 days, those debtors from whom the money would be collected within a span of 90 days will be considered for the purpose of computing drawing cost. If the amount or if the debtor is giving, if it is likely that the debtor would not be able to pay the money to the customer within 90 days, then such debtors would not be considered for the purpose of determining the drawing cost. The third factor is the liabilities. Liabilities are nothing but payables, which are nothing but creditors. When we compute inventories, we have to reduce the unpaid stocks. Unpaid stocks are nothing but your creditors. Such creditors are to be reduced from the inventories for the purpose of calculating the drawing cost. Now, these are the steps of calculating the drawing cost. First, you have to determine the value of the current assets. Current assets here includes your inventory, receivables, and you have to reduce your creditors. Second is you have to deduct the value of borrower's current liability as in payables. That is nothing but reduction of creditors. And third is you have to apply the bank's lending norms and margin to arrive at the drawing cost figure. Now let's understand these steps with the help of an example. For example, if raw materials, work in progress, and finished goods, this is just a hypothetical example, wherein I have assumed that the raw material of an entity is 100 million, finished products would work in progress is 25 million, and finished goods are 75 million. And debtors in this case are 125 million. In this case, as per the sanction terms, percentage of margin would be specified. Now, what is a margin? When a company goes and applies for a CC limit, the bank will not fund 100% of the raw materials debtors which are there in the business. Bank will say, I will fund 75%. You put in 25% of your margin. You have to put some contribution. So the contribution that comes from the side of the customer is called the margin. So in this case, we have assumed that the margin of 25% and 40%, 25% for raw materials and 40% for debtors has been assumed. So the advance value or the value which would be funded by the bank in case of raw materials, net of margin would be 75. In case of work in progress, it will be 18.75. And in case of finished goods, it will be 56.25. From the raw materials, we have to reduce the customer's margin to arrive at the loan amount. Similarly, debtors, we have assumed that debtors have a 40% margin. So, assuming 40% margin on debtors, the value of debtors that would be funded by bank is 75 million. Now, generally, the margin of debtors is higher than the margin on inventories because giving funds against debtors is a highly risky. It is more risky than funding inventories. Hence, the margin stipulated on funding debtors is higher than the margin stipulated for inventories. Now, in the above example, if the current assets of 325 million is being invested in the business, then bank would fund 225 million. That is, you get a loan amount or a drawing power of 225 million, and 100 million has to be contributed from the customer side, which is nothing but the margin. Now, while calculating drawing power in any CC account, drawing power would be the lower of the CC limit sanctioned by the bank and the advance value. For example, suppose the drawing power sanctioned to the customer is 250 million and the advance value as in the above case is 225 million. Then the customer can use the CC limit up to 225 million. Assuming that the cash credit limit sanctioned by the bank is 200 million and the advance value or which we have calculated based on the drawing power computation it's 225 million. Then the customer can use only 200 million. So the amount of drawing power, amount of limit which is utilized by the customer would be the lower of the limit, CC limit sanction and the advance value. Few things that needs to be excluded are raw materials will exclude the unpaid raw materials, that is raw materials on credit, and value of stock under LC or guarantee. Value should exclude raw materials should exclude obsolete stocks. Obsolete are slow moving stocks. In this instant case, the raw material of 100 million, we will ready, suppose assuming we are having an unpaid stock of 30 million and stocks under LC of 10 million, the net raw materials will be 60 million. Assuming there is a margin of 25%, that will be calculated on 60 million and not 100 million because from raw materials, we need to reduce the unpaid stock and stocks under guarantee. So on the 60 million, if we assume a margin of 25%, then the customer's margin would be 15 million and the bank's loan will be 45 million. Similarly, work in progress will be 18.75 and finished goods would be 56.25 respectively. There are some concepts which are to be remembered while calculating drawing power. As far as raw materials are concerned, we must exclude the unpaid raw materials and the values of stocks under LC or guarantee and obsolete stocks. These three needs to be excluded. As far as debtors are concerned, one needs to refer the sanction conditions to know the actual number of debtors that would be recognized in computing drawing power. If debtors up to 90 days are allowed for computing DP or drawing power, the bank should consider those debtors whose age is less than 90 days. For example, if total debtors in the above case is 125 and assuming debtors up to 90 days are 100 and debtors above 90 days are 25, then we need to take into account only debtors up to 90 days, which is nothing but 100 in this case. So accordingly, you would come to know that as the quantum of debtors reduces, the quantum of drawing power would also be reduced. See, the above case, when the value of debtor was 125, the drawing power we were getting is 195. Whereas when the quantum of debtors reduced to 100, the drawing power came down to 180. So these are the few concepts that we need to understand before calculating the drawing power. Now, what is the role of drawing power in credit monitoring? See, drawing power is a key matrix used by banks to monitor the utilization and health of the CC account. Tracking changes in drawing power over time can help in identifying the potential issues or opportunities for borrower. And accurate drawing powers calculations are essential for ensuring compliance with banking regulation and risk management policies. Importance of accurate drawing power computation. See, if the drawing power is accurate and precise, if the calculations are accurate, then it will help to ensure that borrowers can access the appropriate amount of credit to meet their needs without over-leveraging or underutilizing their facilities. It also helps in risk management. Accurate drawing power figures enables banks to access the risk associated with cash credit accounts and implement appropriate risk mitigation strategies. Profitability. Effective drawing power management can improve the profitability of cash credit accounts by optimizing interest income and reducing the risk of defaults or write-offs. Challenges in drawing power computation. The main challenge faced generally by banks is data accuracy, because ensuring accuracy and timeliness of borrowers' financial data, such as inventory and receivables, is crucial for calculating the reliable drawing power. Second is your valuation complexities. Determining the appropriate valuation methods and haircuts for various asset types can be challenging, especially for specialized and illiquid inventories. And there are other drawing powers also influenced by other factors such as market conditions, customer demands, and borrowers' financial performance, requiring continuous monitoring and adjustments. So, what are the best practices and recommendations? We need to regularly review and update the drawing power calculations to reflect changes in borrowers' financial position and market conditions. Hence, for regular monitoring of the accounts, bank would insist the customer to submit the drawing power on a monthly basis. Second is the automated process. We need to implement technology-driven solutions to streamline drawing power computations and enhance accuracy and efficiency. Collaboration with borrowers, we need to closely work with borrowers to ensure the availability of accuracy and timely financial data required for drawing power calculations. Stay up to date with industry's best practices and regulatory changes and emerging trends in drawing power management. Thank you for your patient hearing. Do hit the like button and subscribe to my channel. Do follow me on LinkedIn too. Thank you.